Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in, take a look, see what people are sharing today. If you want to follow me, it's at Fair Square Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics and subjects looking for potential investment opportunities, and I share those with everyone in the community. I also share a lot of other things that people ask about in terms of market conditions, technical analysis, fundamental analysis. We recently went over conference calls of companies that we are interested in and ones that I'm digging into that have very good potential technicals also aligning and good value. So I'm trying to find the confluence of a bunch of things that are in alignment for long-term investments. I am not a short-term trader. I don't try to necessarily time the markets for money. I try to time the markets through the value of the entry point on the investment. So some people will say, well, the stock, well, I try to time my entry points as best I can using technical analysis, but your technical analysis is only as good as maybe 50, 60, 70% of the time. And capturing absolute bottoms are incredibly difficult. But we do have a special going on. Special is the coupon code. And you save 50% off the first month and a larger discount on the yearly membership. So Northstar, he's got this NASDAQ versus gold. The only way to avoid a tech stock crypto meltdown is to reverse this breakdown. That's it. It's simple. There's a major thing here to understand about this chart that I don't know if he knows it. Maybe he does know it. Maybe he doesn't. I don't know. But what drives gold is quote, the safe haven asset. NASDAQ is not a safe haven asset. So when gold outperforms the NASDAQ, generally it could be we've got a slowdown in the market. And that is when you start to get these breakdowns. And when you get a slowdown in the market, it is a transfer from one market condition to another market condition. So if you were to look at history, we rolled over in the year 2000, which is at this peak on the left-hand side. Let me move it over so you guys can see that. This peak over on the left-hand side over here, you can see my mouse guy. This peak was in 2000. It rolled over in 2000. We got a buy signal in the commodity to stock ratio in 1998. Gold outperformed the NASDAQ at the top here of 2000. And since 2000, we had a massive commodity bull market that occurred in this market condition where gold was outperforming the NASDAQ. So as we're looking forward to today, in the year 2009 and the year 2011, we did a double bottom, and it would have been like buying a bunch of tech stocks in this bottom here, like it is commodities today at this top up here of this double top. I'm sure if you were to inverse it, this is a double bottom in commodities. So your double bottom is the double top in the NASDAQ. Your double bottom here is your double top in commodities. And the market condition as you go down and you go up and you go down, it just flings back and forth your asset classes. So money flows into commodities and precious metals. Money flows into NASDAQ and S&P 500. It rolls over when valuations get too expensive, and then it goes and money goes from overvalued to undervalued assets as we go down the next decade plus. So if the peak here was 2000, we bottomed in 2008 and 2011 here. Conversely, we bottomed or topped in about 2021 or 2 here, and this one here is 2024. And we're probably going to go down for 6 to 10 years or something like that. And that's what I'm playing, the strategy, if you guys want to know what I'm doing. A lot of people get frustrated because we've been chopping sideways up here, putting in these large bottoming patterns. We have broken out of some of those bottoming patterns, and we're doing retest moves. This is right before we start to move into this commodity bull market. That's what this is signaling, this ratio. The ratio is evidence of changing market conditions. And I don't know if people understand what I'm saying. I'm trying to break it down as best as I can. But commodities outperform when this happens. And the turning point is when gold breaks out against the NASDAQ, because that's your slowdown. At the beginning of these stages, you can have a lot of volatility because the NASDAQ and the S&P generally top out around here, just like 2000 here. They top out and they can drag and pull markets from margin calls and all these other things. It can have an impact and drag down commodities with it for periods of time. There could be air pockets. Air pockets meaning that we get slowdowns in commodities too, because the overall market is shifting underneath. The money flows are starting to shift. And things can go, we can get a slowdown. Last time, the 2001 tech recession, we could have something very similar to that. But this is the beginning stages of the big commodity bull market that's about to come, in my opinion. I'm going to read some quotes here. This is more from a different perspective. It says, I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. And all that really means is that avoid overvaluation, because when people are greedy, there's generally overvaluation there. And then be greedy when others are fearful. That's using fear, because fear brings prices down faster. And if you can buy the undervalued assets when there's fear in the market, that's where you make the most amount of money. And it is really that simple, but it's hard to teach others to be as greedy as possible when stocks are incredibly cheap, because there could still be volatility in it. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes, says Warren Buffett. It means that you own a good business and you're comfortable owning the business that you can own for more than 6 minutes. A lot of people don't hold stocks for very long. They don't size up the big moves. And what they try to do is they try to use market timing to gain money. The problem is market timing doesn't make any money. And I used to try that strategy back in the day, but I outgrew that strategy because it didn't make any money. Some people say, well, you're just not good at it. Well, show me people who've made a lot of money doing it. There isn't any. And you can't do it repeatedly or consistently. Some people can get hot and then they get cold, and then they don't make a lot of money doing it. So the big money is made in sizing up the big moves, which I just described in the market conditions before this. And that's where all the big, in my opinion, where the big money's made. And what is big money? Big money means that you are averaging 40, 50% yearly compounded annual returns for a period of time. It doesn't mean that will happen all in one shot. Sometimes you'll get pullbacks and you might be down a year or two. And then you'll pour on the returns in, say, wave 3, because we're right in wave 2 at this moment. And that's Elliott wave analysis that I'm referring to. It says market fluctuations are your friend, not your enemy. That's where you get to load up. Here's some more quotes. Timing the market versus buying the right businesses. So here's one from Warren Buffett. He says, the real fortunes in this country have been made by people who have been right about the business they invested in, and not about the timing of the stock market. I can't recall ever once having seen the name of a market timer on Forbes' annual list of the richest people in the world. If it were truly possible to predict corrections, you'd think somebody would have made billions by doing it. The best trader is Jesse Livermore. That's who accounts, at least a lot of people have named the best trader. That guy made a whole bunch of money multiple times, but went bankrupt many times as well. He had timed it, put a whole bunch of leverage on it, had big boom and bust cycles. but that is who is, quote, the best trader. And he went bankrupt, I think, 3 times. He ended up poor, and I think he committed suicide, but that might have been due to his wife, who apparently had married multiple guys who all ended up in death or suicide. So I don't know if they committed suicide themselves or if she was the one that did something. Here's another one. I'm just reposting this. I posted this July 12th, 2023. I said, what happened in the 1970s and 2000s timeframes? Gold price increased because of these few main drivers. Credit expansion from demographic buying homes, decline in production supply of gold. Gold was cheap to stocks ratio. These same drivers are in place today. Technical charts look awfully good right now, and all of the ratios are a hit right now. And this is your decline in supply in the 1970s, a decline in supply of the 99-2000 era. And today, looking forward, these are the forecasts from Barrick Gold. We peaked in supply of 2020, and they have projections going down in the future. It's the same market conditions setup for gold to go higher. So there's other cycles that lay on top of this, like the yield curve and inflation, disinflation, and stuff like that on the shorter time frames. This is a longer time frame view at it. And these were your big bull markets that occurred, at least in gold. And there's other things that stack on top of this as well. Long-term oil price, I keep posting this chart. I still think that we are in a secular bull market for oil. And by looking at the comments in underneath a lot of these videos, I don't think people understand what a secular bull market is. A secular bull market is when you trade in a bull market for like 10 plus years. So if we were to look at this chart, this is the chart that I had posted. A secular bull market is the bull market that occurred from bottom to peak here, from bottom to peak here, and from bottom to peak wherever we peak out there. That's the secular bull markets that I am talking about. Now, people, what they do is they focus in on and they zoom in the very short term, and then they say that the squiggles, these small squiggles in the short term here, this is your bear market. This is your bull market, your bear market, your bull market, and then they get all worried because it's chopping sideways. That is not what I'm talking about. What I think is occurring, and these come in cycles, is that the cycle here is the ending of the last cycle to the completion of the next cycle. The ending of the last cycle, which is this, you can see what I did there. This cycle here, the 1, 2, 3 hump consolidation, this consolidation also occurred under the same market conditions that both of these have occurred in. They were market conditions that had low inflation, lowering of interest rates, and then at some of these cycles, you had an increase of credit and a contraction of supply, which is your upward phase. I think that's coming is exactly what is shown here. I think we are going to see a move higher up into multi-$100 oil. The cycle started in 2020, and we're getting our large pullback right now. Now that pullback, we don't know the exact length of it. We don't know exactly how long it will be, what it will look like. But you can go and you can listen to all these conference calls. You can look at all of the data backing the supply of oil. You can look at the undercapitalization of offshore and all these other swing producing areas that are the high cost producers. They're all undercapitalized compared to history. The cycle just repeats and repeats and repeats, and you can use any of those metrics to tell you where you're at in the cycle. Now, in the short term, we can have cyclical pullbacks. Cyclical are pullbacks that occur in a larger trend. So if the trend is up, you may cycle like this on an uptrend. For Elliott wave, we can call this 1, 2, 3, 4, and 5, which is the eventual peak. These are cyclical pullbacks in a secular bull market across the entire thing. That is what I'm invested for, is the big secular bull market, buying in these areas here for the big secular bull market that is occurring. So I'm using cyclical with a C pullbacks to buy more equities and commodities for the bigger picture move that I think is occurring. And I'm using the fractals. I'm using this repeating pattern over and over and over to gauge my area of where we're at in the cycle. That also overlays with the real estate cycle. So that is confluence. The real estate cycle occurred here, and we're in one right there. And we're going through a slowdown. The thing that pushed us up and above here was the response to the slowdown of the 2000 crash. They lowered interest rates and then they just gave out loans to everyone. Now they're going to probably lower interest rates, lower the dollar, and we're going to have the same condition that's going to push oil upward. Now, I can't tell you if that's going to happen this year or next year, but it's probably going to happen at some point over the next 6 months to 18 months, however long this slowdown would like to last. And this is part of what I'm basing it off of. I'm also basing it off of where stocks are cheap and expensive. Commodities were cheap here, stocks were expensive. Coming up to the 1980, stocks were cheap here and commodities were expensive. Commodities went sideways under a 3-hump consolidation while equities ripped to the upside. The cycle has repeated over and over, where commodities are cheap here, they're expensive here, they're cheap here, they're expensive here, they're cheap here, and then they're going to become expensive. That is the cycle when looking at oil and comparing the valuations against stocks. I developed the thesis 100% against all of the charts and data that I use, and going back into looking at real estate cycles and inventory levels and all of that stuff. That's where it's being derived from. We are in a commodity bull market as we speak, and the cycle is turning as valuations peak in the NASDAQ and the S&P, and as gold outperforms, which coincides with the first graph that I showed you here. This is all coinciding with exactly the same thing that I just described and showed you. They're all interconnected. Trump wants to refill the SPR. People need to realize that the dominant portion of U.S. shale crude oil production is 40 plus API gravity. So what that means is it's a certain viscosity. And it says SPR crude quality needs to be in the 25 to 35 API gravity range. Where is he going to get all that crude? Venezuela, Mexico? Yeah, right. That's heavy oil is what he's describing. We don't have any heavy oil here. We can't refill the SPR with oil that we are generating in the United States. I don't think people understand this. Everybody thinks oil's the same. It isn't. It has different viscosities. Now, is there a way that we can chemically alter things, or is there ways that we can change the refining capacity, refiners to change their refining capacity to accept lighter grades? I don't know. I mean, we could, but it's going to cost a lot of money, and I don't know if they're willing to do that. But here's U.S. crude storage with SPR, and we're still at very low levels. And Saudi Arabia and OPEC, they're going to increase slightly their production. It's because we have such low inventories. They have to. They're bringing back barrels, not to flood the world with oil, but because the world needs the oil. And our inventory is low. And if they don't increase production into the driving season, we could really increase the price of oil quite a bit. So we'll see what occurs. But that's my take on that. Here's if semiconductors complete this massive top on a relative basis, it's a big problem. Buyers need to step in and repair the damage here. And I don't think they're going to. I think it's going to go down. And this is the semiconductors versus the S&P 500. And this is generally what you see at market tops of the NASDAQ. Goldman's comment on OPEC plus decision, we can read through this real quick. The oil comment is 8 OPEC plus countries raised production on lower inventories. So the 8 OPEC countries, which previously announced voluntary production cuts, announced they will proceed with a gradual, flexible, and reversible return of the 2.2 million barrels per day of voluntary cuts started in April 1st, adding 130 to 140,000 barrels per day per month. This increase is set to start 1 quarter earlier than our prior July assumption for 4 months of increases. The production increase likely reflects 2 factors. First, inventories are down year over year, directionally consistent with resilient crude oil time spreads during the recent sell-off in oil prices driven by long-dated prices. Second, as we wrote last summer, the market is likely shifting modestly from an equilibrium where OPEC supports spot balances to a more long-run equilibrium focused on strategically disciplining non-OPEC supply and supporting cohesion. The mechanical downside to our oil price forecast from pulling forward the start date for our assumed 4 months of production increases by 1 quarter is only $1 a barrel. That said, we see 2 sources of downside risk to our 78-73 average Brent forecast for 25-26 and 74-68 for WTI and our 70 to 85 Brent range. First, supply may be higher than we expect. Specifically, the negative response of U.S. oil production growth to sub-$70 Brent prices is a more lagging rebalancing mechanism than OPEC's production cuts. And B, longer OPEC production increases are possible. Second, softer U.S. activity data and tariff escalation implies some downside risk to oil demand. That's what Goldman says, at least. Trump is going to get lower rates. They are saving bonds by crashing stocks. Like and repost if you understand this. What they're trying to do, well, what he's saying is they're trying to get lower rates, which is basically demand for bonds. So they're crashing the stock market to increase the demand for bonds. You also crash your dollar if they're printing money doing that. This is a classic rotation out of stocks and into poverty, says Douglas Boneparth. I thought that was kind of funny. Performance of precious metals in the last 3 mega bears, from exact top and bottoms in the S&P 500, 73, 74, 2000, 2002, and 07 and 09. The S&P had pretty big drawdowns, about 50% drawdown, and a 57% drawdown. Gold was up 196%, 13%, and 24%. Silver was up in the 1970s, 73, 74, 147%, down 17%, down 4%. And then the miners were up 195%, plus 65%, and minus 31% in 07 and 09. And that is the returns of those mega bear markets. Tavi Costa says, this is arguably one of the most important charts that I have seen recently. The US dollar is currently at one of the most overvalued levels relative to other fiat currencies in over 120 years of data. Comparable extremes in 1933 and 1985 were ephemeral and preceded significant devaluations. I don't know this word here. That's interesting. But here's the peaks there, USD peak, USD peak. And we got a question mark. Maybe we've got another USD peak in terms of its dollar index peaking. These big moves lower, they generally drive, they could drive dollar-denominated assets up because you're losing valuation of the DXY dollar. Smart real estate bets. I like this guy because I think he dissects the data correctly and comes to the correct conclusions. So here's a 3 post one. He says some historical context as to how current supply levels, especially of single-family inventory, look relative to this millennium. And the bubble in particular can be our friend. So buckle up. Is that like timber? Single-family existing home supply from 89 to 2024. Look where we're at. Super low. We have no supply. Coming down, and this is in response to Danielle DiMartini Booth, who is like the housing bear of a lifetime. And she's quoting Nick Gurley, who's like the housing bear of forever, a perma bear. But the data doesn't support it, in my opinion, and neither in his. We've got low existing inventory of existing homes, single family. It says, why do vacancy rates remain so low, despite protestations to the contrary from the loudest people in the room? Maybe it has something to do with the massive surge in household growth we've experienced after a decade and a half of collectively anemic supply growth. So we've got the vacancy rate also at incredibly low levels. This here is evidence against those that think we've got this, a ton of vacancy out there. We don't. This is your data. Here is your annual U.S. household growth from 65 to 2023. This was the big bull market back in the 70s. And then you can see what it was in 2000, 2005, flattish. And then here we've got another big household growth formation. Here's single family construction. You can see we underbuilt compared to household formation. So we had all these buyers coming in and we're not built up for it. This is the average, about a million, it looks like, from 1968. And this is where we are below. And the area under the curve is our mismatch. This is a big area under the curve here between the average and up. That's a big expansionary phase of real estate. This is your bust phase where we underbuild. And then the cycle repeats over and over. And then this is your new households versus new housing units from 1999 to 2023. So new households are up and they're above the units completed. So this is the area under the curve. The deficit is your deficit there. And we are continuing to have deficits as we go up. It's just one big fat deficit. So we don't have enough homes. And then there's people who I don't know why they use this data. They say, well, we've got this many houses per capita. And I'm like, well, that's absolutely worthless. Yes, some people own two homes and they're not willing to sell the second or third house. And they could be in areas that benefit no one. If a person's looking in Atlanta to buy a house and a person in Atlanta owns another house in Florida or Minnesota or something, doesn't matter for the person who's in Atlanta looking for a house if they own a second home in Minnesota for a summer vacation home on a lake somewhere. It doesn't work. I don't even understand half the arguments that people make on some of these. But what about affordability? It says we can look at that like it's at all-time lows too if we pretend the housing market did not exist before YouTube. Look farther back and you'll realize that 2009, 2021 was the era when ownership costs were abnormally low. So when we look back in history, housing affordability, it's higher, but this is all abnormally low. And if you look kind of in history, this is history. What they do is they focus on this here. They say, "Oh my God, look at this here," and then they say, "Look at the affordability. It goes all the way up," and that's all they're looking at in terms of data. But if you go back and you look at the data for all of what it is, affordability. This was the anomaly was from 2009 to 2020. That was the anomaly. That was the time to buy a bunch of homes. Now affordability is back to normal compared to history. Affordability was much worse in the 1980s. So they pick and choose the time frames that they like to share, and they chose to compare it against the most affordable time to buy a house in history, basically. This time and this time down back here in the early 70s, before the big household formation hit. Lumber is breaking out of a 2-year base. Now that's a big deal. If lumber is trending higher and copper is trending higher, what does that say about global growth? It's going up. Lumber going up also indicates that you're in an expansion phase of real estate and that we're building more new homes or just building more in general, put it that way. Lumber prices are ripping. 30% off softwood sold in the U.S. comes from Canada, and it's another one. The new Samsung solid-state silver battery for EVs uses about 32 ounces of silver. It's a quantum leap from any battery currently available. Oil and silver have an incredible future. I agree. They do. Capital rotation progress update. The key to a true precious metals bull era, the gold to SPX ratio, and we're starting to break out in that as well, where gold is starting to outperform the S&P 500. That is the rotation into commodities. Your valuations are going to go from overvalued equities and NASDAQ and S&P into undervalued commodities and precious metals and the companies that sell commodities. This is your gold versus Bitcoin. It says, damn, that's getting tight. The ratio between gold and silver. So basically commodities versus tech. And we could get a big breakout here of gold beating Bitcoin. That is, in my opinion, a function of the market conditions. Like I said earlier, the market conditions are a function of money flowing into tech under a recovery phase of real estate and flowing out of it during an expansion phase of real estate. And we're entering and in an expansion phase of real estate where we could see this go up, where gold outperforms technology. This is Microsoft versus gold. It's already broken down. So gold's breaking out against Microsoft and a various amount of other equities out in the world. This one here is Google versus gold, and that's breaking down as well. So it's a function of the market condition and money flows. The end of the last bear market for real estate was 2009 and 2011. And that's where all these tech guys bottomed and went up. And money, since interest rates are lowered, money gets forced into stocks. It seeks returns. And that's where the returns come from. It's money coming out of the bond market. The bond market goes up when interest rates go down too, but it squeezes people out of the bond market if interest rates go too low, and it searches better returns, which then drives the valuations up in the stock markets. And then when interest rates reverse, it all reverses here. You'll see gold start to outperform. You'll see commodities outperform because they've generally been underinvested in. And then when interest rates go up, it basically puts a headwind against the S&P 500 and the NASDAQ. And this is the 10-year cycle, roughly 10 years. A little bit longer than 10 years. This one was the bottom of 2011 all the way to what we'll call a top of 2024, 2025. So a 13-year cycle there. And then Josh Young says, did Saudi Aramco just say the quiet part out loud? 1 million barrels per day of spare capacity is far less than the consensus 3 million. When we had the last bull market in oil, we had 2 million barrels of spare capacity. I'm not so sure that we have as much spare capacity as what people think. And if we're at the pumping capacity of the world and demand starts to exceed it, then it becomes demand destruction price, and I think we're going to go way up. And if people realize that we don't have this spare capacity, it's gonna move up a lot. The plebs don't care about silver, while big boys are standing for massive physical silver deliveries. Just an FYI on that. Breaking platinum shortage and backwardation in platinum. 5 out of 6 of our usual platinum suppliers, both refineries and wholesalers, are out of platinum. Platinum is now in backwardation, a potential bullish signal. While gold's supply tightness has dominated headlines, platinum shortages has been building in the background. Gold has significantly outperformed platinum in the last 10 years. Think of the market conditions, guys. With strong demand and supply constraints, it may be worthwhile to also keep an eye on platinum. I agree. And when platinum outperforms gold, you are also in a commodity bull market. When gold outperforms platinum, it's a function of the market condition. And that's where I don't think people understand this. They don't look at history. They didn't look at the research at Yale and the research that they have done on the platinum to gold ratio and gold to platinum ratio and the market conditions that work with those. So if we're coming into a commodity bull market, platinum outperforms gold. And we are in an anomaly for that ratio right now of how cheap platinum is in relationship to gold, palladium, and silver. It is cheap against all of the metals. There's been other anomalies in history where we've seen this type of cheapness in palladium, in rhodium, in silver, and in gold. Gold was 99, 2000. Palladium was in 2009, and rhodium was in 2016, where these things just went 30 times, 100, what was it? $680 to $29,000 was rhodium. Palladium went from a couple $100, $200, $300. I think a low was 175, all the way to $3,000 an ounce. We are at platinum at about, let's just say $1,000 ish. The ultimate bottom was about $700, 600, $700. We're probably going to go all the way up to, we could even go over 10 grand. So, but that's going to take time. That's at the end of the cycle. And there's times where platinum does exceed. I should restate that. It could do it in the beginning of the cycle, and then silver outperforms the back end of the cycle. Very well could happen. But right now, platinum is the cheapest of the group. But that's what I've got for today, guys. We're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special is the coupon code. And we'll catch you guys later. This is Finding Value.